Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, commodities, and/or financial topics. So I'm going to dive in there, take a look, see what people are sharing, and share my opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, I dive deeper into all of these topics, looking for individual financial opportunities, companies, sectors, whatever's down and looks like it's bottoming. I have a collection of what I think are the best companies in those sectors. I cherry pick through everything. I make my entry points and then I sit and do nothing. I wait for them to go back up. You do that with 6, 7, 8 different sectors. Some of them are in their stride going up. Some of them are bottoming and some of them are topping. And that's where you can take your positions at the bottoms, ride it on up. Generally, they take at least a few years or longer to work their way on up. If you're playing the entire commodity bull market, it may take from bottom to top about 10 years or so or more. And then you just ride it. You can create core positions. If you guys want to trade around it, that's fine too. But that's exactly what I do. We've got a community of like-minded people that we basically go on Discord and talk back and forth. We've got question and answer sessions that you can ask me directly on the weekend. And you also have midweek updates where I go through a lot of these sectors, giving my opinions and telling you what I am doing in my portfolio and how I'm positioning and the sectors and companies I like that are low. If that sounds interesting, I would sign up using the May Day coupon code, MAYDAY, 50% off the first month in the monthly membership and only the first month, and then a larger discount on a yearly membership. And that is open to anyone who wants to sign up for the yearly. If you want to switch to monthly to yearly, that will also work. Starting with copper and ideal buy points or spots. Copper has a double bottom. That bottom made the double bottom in 2020. It broke out of the double bottom, did a retest in 2022, 2023, which is your ideal buy point, and then we've been working our way higher and higher in copper. This is a stage 1 bottom. Now we're in a stage 2 move in copper. Your stage 4 is the decline here. Stage 3 is the top. So top, decline, bottom, upward, and then the move on up. So that's what it looks like for copper. And if you were to look at technical analysis, the ideal buy for the investor, it is a double bottom and then a breakout, B backtest, and B is the backtest. This is for a technical analysis trader. As you get better and as you get more experience and you become more patient as an investor, it is possible to buy the bottom right-hand side of this double bottom. You will not buy the absolute bottom. You might buy it up here on accident, thinking it's the bottom, and you might buy a little bit as you cost average in this entire bottom. Your total return, if you can ride it to the top of down here versus point B, is substantially different. I mean substantially. It could be a difference between a 5x for B and a 20, 30, 40x for the person who can buy it down here. It takes courage. It takes patience. It takes patience is probably the number one thing it takes and is required to buy this right-hand side. I have purchased a lot in the right-hand side, and I continue to do it. And I am not afraid to hold on and be patient for things to turn out and work out overall. If I am down here for 6 months or a year or 2 years or 3 years, I don't care. Remember, I'm not all in on one company. I'm not all in on one sector. So if one sector is, quote, lagging to what most people will think is lagging, and other sectors are going up and they're up here, well, that's my portfolio return. And then as things cycle, the strategy that I deploy is I buy things down here, cost average in these corners, and then ride it on up. So on the website, what I do is I go in and I look for things that are down. We have positions that are at B right now in certain sectors, and we have things that are down here that are still coming on up. I've purchased from this bottom. I've purchased from the things coming on up. Specifically gold and silver mining companies, I've purchased this corner. I've purchased the things up here, and I've purchased things that have broken out and doing retest. I buy all of those spots, and then that adds up for a ridiculous return. So what I do is I find something low, I buy it, I wait for strength to show up, and then I buy into strength. So that looks good. That looks good. If you guys want picks, that's where I have them. Uranium still looks bullish to me on the long-term. Flight still in progress. So we've got the flight going. It is still in progress. I'm going to read a quote later in this where it talks about patience. What I witnessed on Twitter here and the exchanges that people were having in the uranium sector were less than ideal, is what I would say. They don't look like experienced investors. So this is your bottom. Your double bottom is one here, second one's here. And then we broke out of that double bottom. Your ideal buy point is the stuff in this corner here. We took full advantage of that on the website in this corner. I even told everybody, hey, look, this is going to be one of your last best opportunities to buy it at a price of, well, for URA, it's for 20, but I was doing individual companies, developers and stuff like that. Big move up. We've had a pullback. People get very discouraged. They start to hate the sector. Apparently, people start yelling at other individuals on Twitter, ridiculing them, telling them that this is the crappiest trade ever. That marked the bottom, of course. And now we've got a big bullish engulfing that looks like it wants to go higher. So what was the best course of action? Yelling at other people and not taking ownership for your own investments. This is what I'm going to tell you if you want to become a good investor. Do not blame other people. Never, ever, ever blame other people. What you need to do is you need to take full responsibility of your investments, trades, whatever it is. Learn from it. Learn from it. Don't try to blame other people. And it wasn't directed at me. It was directed at other people, which I think is ridiculous. If you want to get good, you need to learn what are the leading indicators. How can I become a better investor? How do I control my emotions? All of those things matter when you want the full thing. Now, I've been riding this since this 2020 area down here. I entered in September, October, November of 2020 in a big way in the uranium sector. How did I do that? That is what you should be asking. How am I able to hold on while everyone else is over there yelling at each other, acting like little children? This is just a game, and they would test kids early in their life. They would put a cookie in front of them. If they ate the cookie, they put a cookie in front of them. They told the kid, if you waited 30 minutes or 15 minutes and didn't eat the cookie, you get a second cookie. That's all investing is. You sit there with this thing in front of you, it goes on up, there's your cookie, and then you wait for a second cookie to come as you can ride through the entire bull market. Technical analysis can help us aid where we're at in that process. Your ideal buy point was just a little while ago. This is not the bottom of the market. It's not going to crash, and I understand why people maybe might get emotional and get scared. It's understandable. But if you want to get better, you got to learn this game. Let the game teach you and learn from it. Don't point fingers at other individuals like, other individuals in the uranium sector and say, oh, it's that problem. They think it's a good sector, therefore, they suck me into it. No, that victim mentality needs to die. It's so bad. Folks, $200 a pound will be a low number one day. So I used to have a lot of interactions with Scott on my channel. We would talk about the uranium price. My price and where I think it is going is probably going to be $400, $500, $600, $700 a pound, with the possibility of uranium going higher, depending on liquidity coming into the system and how scared people get. Historically, we've seen a one-to-one relationship where oil and uranium basically trade at the same price. I think oil is going to go $4, $5, $600. I think uranium will probably go $4, $5, $600 in that general area. So $200 a pound, that's probably going to be the break-even cost after inflation's accounted for in the late 2020s. It'll be $200, $300 a pound break-even costs. So inflation is going to be a big driver of this, and the margins of those companies are obviously going to expand and shrink depending on what inflation is. So this here is specifically talking about Russia is preparing a ban on the export of the most important raw materials to unfriendly countries. They specifically call out a few materials. It says the so-called transition metals, in particular uranium, nickel, and titanium. For example, we talk about uranium, then in 2023, the country in monetary terms occupied about 29% of the world market, 2.7 billion, and in the physical terms, 32%, 1.9 thousand tons is what they control, so to speak. So again, I don't base my investments off any of this. What I think is coming, and I'm just going to flash this chart up. And most people, this is the global liquidity index. I'm bringing this back, and we're starting to head higher in this global liquidity index. This is driving gold higher. It's going to drive with a slight delay from this bottom. There's going to be about a 2-year delay. That bottom occurred in September, October of 2022. 2 years puts us to where we are today, September, October of 2024. This is going to drive uranium higher. It's going to drive oil higher. It's going to drive all these things higher. Now, are we at the absolute bottom? I don't know. Of oil and some of these things. I don't know, but we're probably pretty dang close. That's what I would guess. This is going to drive it. This has driven it for the majority of other years, is that money gets into the system, it pumps it into the system, and then we see a move higher over time. And if the sector is supply constrained, it's just going to add to it. So this has a little bit of a lag. This is going to lead, you're going to get a lag, and then it kind of flows through the system. And then once that money starts to get flowing and rotating, it could continue for a while, depending on how undervalued it is. So all of this is kind of lining up for what I think is a bull market in commodities in general. Gold's our leader. Gold's been ripping, and uranium and oil and all the other ones are going to follow. And our technicals match it. The technicals here match it. The technicals in COPX match it. They all match what I'm saying. I'm not just making this stuff up. It says your outcome in life will be way more satisfactory and way better if you work under people you really admire, and that's been my problem. Some of my managers, I don't admire them at all. I don't even admire the people above them. So it was a really tough spot to work in some of my areas. And I didn't really realize that when you're younger. You kind of just work, you get through it. You live weekend to weekend. But as you get older, it matters more. And this here is totally spot on. You got to work for people that you want to work for, that you like working for, and that you admire. I'm going to read this quote. It's probably the most important quote that people are never going to adopt. But if you're serious about investing, you need to listen to the words that I am saying here. So this is from Jesse Livermore. Jesse Livermore is quoted one of the best traders. He did make many, many millions, lost many millions, went bankrupt a few times, made it back, lost it, made it back, lost it. So this guy was leveraged to the hill, and I wouldn't say that he's better. He's not the best investor. He's a guy that learned some things along the way as he was trading. And then he ended up, I think, committing suicide, but he did marry, I guess his wife was married to many partners. I think it was 3 that committed suicide, so it might have been her. Who knows? But I think this is an important quote, and it works for investors. He says, "It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight. It is no trick at all to be right on the market. You always find lots of early bulls in bull markets and early bears in bear markets. And their experience invariably matched mine. That is, they made no real money out of it. Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make big money. It is literally true that millions come easier to a trader after he knows how to trade than hundreds did in the days of his ignorance, says Jesse Livermore. So, and this isn't on here, but in the book, if you read it, it's about sizing up the move. That's what they call it, sizing up the move. The way that you size up the move and the way that I implemented it in my strategy is through ratios. Ratios and technical analysis. You can size up the move looking at Fibonacci sequences, looking at the ratios and how much running room you've got from riding a cost curve and a low ratio to a more expensive ratio and demand destruction. That's kind of your outer boundaries. So this is important because you want to ride from the outer boundaries from low to high to make the biggest move. That is called sizing up the move. And sizing up the move and being able to hold on the entire time is the hardest thing to do. And what's going to happen in this uranium bull market and the majority of retail investors, I'm just going to tell you straight up, this is how it's going to work. This is what the quote that's going to pertain to you. Men who can both be right and sit tight are uncommon. And again, what you're going to do if you're trying to sell because you're emotional and all of those things, it says, it is literally true that millions come easier, or hold on. It is. You will always find lots of early bulls in bull markets and early bears in bear markets, and their experience invariably matched mine. That is, they made no real money out of it. So if you're going in and out and you're getting confused and emotionally trading, you're going to have this big uranium bull market. It's going to come and go, and you're going to make no real money out of it because you've been trading in and out. You need to take this to heart. I can guide everyone who's on this community. I can guide you as best as I can. But if you're trading in and out, changing your mind, swapping things, chasing price performance because company A went up 30% and company B didn't go up that month, it's going to hurt you in the long run. You need a strategy. You need to figure out where you want to position. You want to accumulate on the cheap, and you want to sit and do nothing. The money is made by doing nothing and sitting tight. And I can't stress that enough. All multi-baggers started with small market caps. That is true of regular companies. That is not true of companies that are in commodity markets. Big companies, small companies, medium-sized companies, you can see outsized returns based solely off of buying the company in an out-of-favor area. It could be a big company that comes into favor and the commodity price goes up substantially. Those are some of the best returns in the shortest periods of time that the market has to offer. Now, in general, smaller market caps do return better than larger market caps, but you can still get incredibly good returns with the best risk reward in some of these small/mid-cap companies. It's the ones that track the commodity price very well. They've got infrastructure in place, and they can still get you 10, 20, 30, 40, 50 times your money. You don't need to take on all the risk in the world. Go into the smallest nano caps and try to do some exploration company. You don't need that. And that is why I try to teach a lot of people how to increase your probability of success. Bobby says, hit like if you're still bullish on uranium. I am still bullish on uranium. Coming to David here, he says, gold. Russia and Iran have started settling parts of mutual trade in gold. It has arrived. And that could have an impact on the demand for gold. Okay, Dr. Copper, we know what you want to say. And here is the Chinese visible inventory. Look at that go down here for 2024 in the orange. Down, 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 down. That doesn't look too bad for inventories of copper. And I know, yeah, inventories of copper in China. China's going through a deleveraging thing. It's got to go through a recovery phase. It's got to do all that. But there we are. Hunter says, I created a median house cost versus median household income chart by state region for the US, UK. It really highlights the scale of the problem. Even affordable regions of the UK are comparable to some of the least affordable states, and London is vastly worse than any state. So this is over here. We got 13.8 for London, which is more expensive than the entire states, anything in the United States. So London is a lot more expensive than the United States. And my question to everyone then is, if London and Australia, New Zealand, and all these different areas are far more expensive than the United States, what makes you think that the United States can't get more expensive and stay more expensive? It's the cheapest real estate, one of the cheapest areas of real estate in the world of a developed country. So what makes you think that we're going to stay cheap forever? We might get more and more and more expensive as time goes on, and it's going to make up a greater share of renters. And the buyers who purchased, it might get more difficult to buy homes, just period. Here's Patrick. He says, crap about to get real quick. This appears to be breaking news. So Russia prepares to ban on exports of essential raw materials to unfriendly countries. Very well could get real. Here is HK Nick. It says, a most preferred asset, this pet rock, UBS recommending a 5% allocation. Remember when Western portfolios in aggregate hold less than 1% of precious metals? And there's gold and raising the forecasts for gold. JC says technical analysis only looks at information from the past. And he says, yes, it must have taken a real genius to figure this one out. Can't imagine how difficult it must have been to filter through all of those other methods of market analysis that specifically use information from the future. Nothing uses information from the future. Nothing does. Everything we look at is looking at the past or present of quarterly earnings, their margins, and all of those things. So the market is trying to look forward 12, 16, 18 months and figure out what is coming. And that's what you have to do. You have to take the current information and then try to project forward what might come. And then some people use trends. Is the inventory trending lower? Is their margins trending up or down? Is their free cash flow, are they becoming more profitable? Are they selling more things, et cetera, et cetera? And then people take a guess or swag at what's coming in the future. And that's all investing is. Gold is money. Everything else is credit. JP Morgan, and he's showing money looks like, which is gold. Gold buffaloes and American eagles. India is going to do to silver what China did to gold in the BRICS. So India imports of silver. Look at that record levels there. Look at that monster move from early 2000s all the way forward. More and more and more imports of silver to India. Nice little three-hump consolidation there, and then the blowout crash before the big move. Gold predictors. It says this chart highlights the gold to USD index ratio, signaling that the gold rally is just beginning and could go much higher. The last time this ratio broke in 2003, gold surged over 300% within 8 years. So there was the big move in 2001 was that recession. 02, 03 was when the dollar started to drop. And this was a dollar move where it peaked in 2011. So this is the weakening of the dollar. That's really what's driving the price of gold. We have a current situation where we've got the dollar starting to weaken, gold broken out, and I think we're going to see further weakening in the USD. So it's not gold moving, it's the dollar that is weakening in the denominator. And I think that's important to understand as an investor. So when you want to look at certain assets and emerging markets and other areas of the world, it's a currency exchange that's the big deal. It's not necessarily the assets in the company or in the countries. Money wisdom, scared enough to save for the short run, brave enough to invest for the long run. Morgan Housel. Says, is the unthinkable happening? German CDU party calls for reactivation of nuclear power plants. Nuclear power should continue to flow. 1 to 2 year restart plans. The Microsoft deal is opening eyes. Germany's second in number of data centers after the US. This has to happen, guys. There's no other option. These guys are going to want power. They're going to want steady power, and they want a lot of it. So what's going to happen? They're going to reactivate anything that is existing. They may even reactivate coal power plants, guys. And obviously, natural gas will play a mix in this. Shorter term, it's going to be reactivation of nuclear. It's going to be a lot of natural gas and maybe even reactivation of coal. In the long run, we're going to have to build a lot more nuclear, period. There is no other option at this time. I hate to say it, but the bulk of power is not going to be coming from renewables. There's no way to, at least currently, there's no way to smooth and store that energy in electricity format. We've got showing these again and again and again. Gold and silver have both broken out hugely and resumed their bull markets. Get prepared in every way possible. You have to believe profit from it. And you only have one chance. There will be no rerun. And silver's broken out. We have broken out of silver. We're sitting on top of the pattern. Get bullish, stay bullish, sit there, do nothing. That's my message here. And again, here's gold quarterly. We've broken out, we're running. It's not hard, guys. You take a position. I took positions really early. I've been sitting in it. I'm just going to sit, make money by doing nothing. Hunter says, I created a map of state median household income adjusted for cost of living. I wanted to find the states that are truly the most prosperous. Expensive coastal states suffered a large penalty, while the plains and most of the Midwest soared. So this is basically your value area. I live in Colorado, and I would say that Colorado is the best value of any state that I could find. And what I did is I took weather, sun, because I wanted a lot of sun. So weather and sun combined. I don't want super, super cold weather. I also don't want super, super warm weather. I wanted a state that had low property taxes. So I didn't want to get taxed out of my house. At the time, homes in Colorado were very cheap when I moved here. That was 2011, 2012. I purchased shortly thereafter, but they were cheap. And the pay here is pretty good. The taxes are a flat 4.4% for state tax. So there is a state tax here. But the cost of living is cheap, and everything is kind of, it's on a pretty affordable side. So if you can get over the home price and you could get in cheap, you basically locked in a good area to live in. I used to live in Minnesota, and I also used to live in California. California is incredibly expensive. They kick you in the nuts in every shot that they can. Taxes, in terms of state taxes, your housing costs are expensive. The best thing about California, though, is if you know the real estate cycle and you time the real estate cycle very well, you can get a cheap house, and generally you'll get cheap property taxes too because it's based off the cost of the house. Then they can't raise your property taxes with the price of the house. They raise it like 2% a year. I think that's like the max, whatever they put in place. I know some of my friends' parents purchased multiple homes in 1999, 2000. In one of I was going to school out there in San Luis Obispo, and they purchased all those homes. I think they purchased 3 or 4 homes, and their property taxes are super cheap even today. They haven't sold those homes. They are rentals. So they made a killing on those, absolute killing. So if you know the real estate cycle, you are doing very well in all of this. And that is a huge portion of the cost of most people. Okay, I already went over that. So that's all I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Mayday coupon code. We've got a midweek update on Wednesday. We've got Sunday 5 p.m. question and answer session coming up. And that's all I've got for today. So we'll catch you next time. This is Finding Value.